The question is, can you actually win in Forex if you keep on trading with a negative risk reward while you're losing two to gain one? In this video, I'll be showing you exactly how you can actually win and profit from the Forex market using a negative risk reward ratio where you're actually risking two to get one. So without further ado, let's get started. Awesome. So this is a strategy overview so that you can easily understand how the signals come about and how you can actually interpret them and use them for your own gain. So first thing, why do we lose in Forex? So one of the reasons I've found is actually three of them. One of them is no repeatable entry. What I mean is you have a system that doesn't have a repeatable entry. You enter today, and then if you get stopped out, you have to wait for another pattern, another moment, perhaps tomorrow. Perhaps we never know when it's going to happen. So one of the reasons is having no repeatable entry, and the other reasons is fear of losing. This is why we find traders trading without stop losses. I've been one of them. Without, I've taken trades sometimes without stop loss, and then you end up losing. So the other one is dejection of losing continuously. This is where you frequently change strategies. You try this strategy, it doesn't work. You change, you try another strategy, it doesn't work, and change again. Sometimes it works, and then you feel good about it, and then you do it again, and then it doesn't work, and then you change strategy. So this is dejection of losing continuously. So these three reasons are perhaps why I see it as a broad view why a lot of traders lose. Now the question would be, what if you had a system that has 100% objective entry rules? It doesn't have variable indicators, no interpretive fundamentals, as well as patterns, nothing to do with chart patterns, harmonics, Fibonacci, etc., or anything like it. So the imagine having a strategy that doesn't allow you to be afraid of your stop loss. You just put a stop loss and you're not afraid of, because in spite of you hitting stop loss, you will still make money at the end of the day, at least almost still make money every single day. So now, what do we call this kind of strategy? So I have categorized this strategy in two classes. So there's bounce, where we trade on a 1 minute and 5 minutes time frame, and the Stochar 3.0, where we're trading it in addition with other confirmations from a different strategy or rather system we created. Now, when I talk of the bounce, we're only trading Euro USD, GBP USD, USD CAD, and USD JPY, and we can do this every single day and make money every single moment. I think before or during the London session open. And then this one is the system. So what I mean here is, let me try and clear this up. What I mean is what we have here. So right here, if you see what's here, it's what we use to actually help us pick a next opportunity to trade from. So I will explain this later as we move on. So this is what we're talking about when you look at the bounce strategy. We take trades from the extreme highs or the extreme lows, and we're targeting 5 pips and 10 pips stop loss. That is on a 1 minute time frame, and if it's on a 5 minutes time frame, it's a 10 pips take profit and 20 pips stop loss. Same currency pairs. And then on the 15 minutes time frame, so on a 15 minutes time frame, this is where we get to put it in touch with this, with a system together, so that it can help us get trades that are more likely and have a high degree of actually hitting take profit of 20 pips. So this is where we use the Stochar 3.0. Now the bounce is only focused on the 5 minutes and the 1 minute time frame. The Stochar 3.0 is actually on the 15 minutes time frame only. So now this is how the whole thing works. We sell on the close or the first red candle after a new daily high. So what I mean is, price is actually made, from midnight, and then price has actually made a new high. So from there, from the topmost new high, we're waiting for price to actually give us the first red candle. That's on a 1 minute time frame, right? And the 5 minutes time frame. So when it does that, we're going to sell targeting 5 pips, right? Targeting 5 pips, and then our stop loss will be like 10 pips. So looking at the 5 pips range, there is high possibility of you actually getting profit. But eventually, when it doesn't work out, it has actually meant that price has actually made another new high, giving you another opportunity, and then you're going to have another opportunity to enter again. uh, this time not with the same position size. Say if you enter with a 1 and then you got stopped out, you sell, and then your 10 pip stop loss has been hit. This time it has actually made a new high. You just have to wait for another new red candle, and then you can actually sell, but this time with a lot size 3 times the first position. So if we use a lot size 1, we get stopped out of the 10 pips, we've actually lost $100. And then because prices made a new high, you know, we sell again after another signal entry, meaning price has actually made another first red candle after making a new high. After stopping you out, you're gonna enter with a lot size 3, and putting the same stop and the same take profit, 5 pips, 10 pips stop loss. So if you get hit with a profit of 5 pips on the lot size 3, you've actually made, you've actually made, that's about, is it $300? $300, is that a bet? 10 pips, one lot size, that's about $100. And then is it okay, whatever the math, we do the math later. And we do the same on the sell side. If price has been going down on the first new daily low, a first close of the bullish candle, we buy, targeting 5 pips, stop loss is 10 pips. So we buy the bottoms and we sell the tops. So what if we get stopped out? Now this is where it gets fun. Let's do the math right now. So when we get stopped out, we try the first one, we lose 1, right? We lose 1. So you enter with a lot size 1, and then we get stopped out with 10 pips, right? And then you've actually made, you've actually gotten another new opportunity to enter again. When you enter again, this time you enter with a lot size 3, right? You enter with a lot size 3, and then same target profit, same stop loss. And then say you get hit take profit. If you hit take profit, the same 3 position size that you've actually used will cover the losses you lost from the 1, and then you've actually made the profits you were supposed to make in the first place. But if you get stopped out again, you have to, it's 3 times what you lost. It's 2 for 1, so it's 3 times what you lost. So from 3 to 9, I've actually approximated it to 10, and then you can just continue just like that. And we just do this for up to 4 times. If 4 times you keep on losing, just walk away from that trade, meaning you've lost that trade and you've lost some money, and you don't have to cry over it. You can do it again and again and again and again. At the end of the day, you find that we are always having, our equity building up all the way up. So this is how you're gonna be reading the forex signals. When I send a signal with a forex scalp, I'm talking about taking trades from the 1 minute and 5 minutes time frame. So I will also be putting the stop loss and the take profit. And when I say forex signal, it's where we're using the Stochastic 3.0 on a 15 minutes time frame, targeting 20 pips. And then there are 2 ways to trade. This is basically lottery mode and insurance mode. So our way of doing it from this perspective is our insurance mode. In spite of what happens, we are insured to say we will make profit from this trade. And lottery mode is where we get to risk 1 to get 2 or 3 or 4 or 5. Now this is based on a different strategy. Now based on this one and the recent strategies we've been taking, we're focusing only on the insurance mode. So this will be continued later. This time, let's get back to trading.